How to start trading Forex for beginners. Foreign exchange risk is the chance of incurring a loss whilst holding a long or short position in the foreign exchange market due to an adverse change in the foreign exchange rates. In relation to the foreign exchange markets, leverage is where an investor can control large amounts of foreign currency with a small deposit whilst borrowing the remainder from the Forex broker. If we decided to invest in $100,000 worth of foreign currency, which then increases in value to $100,000, an increase of $500. What is the return on investment? Using the example above, it is easy to understand that one of the keys to managing your risk is the amount of leverage applied to each trade. The bigger the amount of leverage, the larger the potential profits, but the flip side of this coin is that any losses will also be large. By adjusting the amount of leverage that applies to your account, you can afford to give each trade more room to maneuver when setting your stop-loss orders, and this in turn will help to increase your probability of turning a profit. You do not have to take the highest leverage that the Forex broker offers you. You should also take the leverage that is the most suitable to your risk level. Whilst many websites will try and convince you that Forex trading is about making millions over a very short period of time, successful Forex traders work to strategy plan which includes good foreign exchange risk and money management.